Why did Basel introduce the leverage ratio? Imagine a world where banks could hide how much debt they really had, making it hard for regulators to see the full picture. That was a big problem before the Basel III reforms. The Basel Committee, which makes international banking rules, wanted to fix that. They noticed that banks were relying too much on risk-weighted assets, which are fancy ways of measuring how risky a bank's assets are. But these methods could be manipulated, and banks could hold a lot of debt without seeming risky. This made the whole financial system vulnerable. So the Basel Committee decided to add a new rule called the leverage ratio. It's a simple measure that compares a bank's core capital, called Tier 1 capital, to its total exposure. This includes everything a bank owns or owes, whether on the books or off the books. The key is that it doesn't consider risk levels, making it straightforward. This way, regulators could see the true amount of leverage a bank had without relying on complex risk models. The main reason for introducing the leverage ratio was to prevent banks from taking on too much debt. If banks borrowed too much, they could become unstable, especially during economic downturns. The leverage ratio set a minimum level of 3%, meaning banks had to keep at least $3 of core capital for every $100 of total exposure. This limit was designed to stop banks from piling up excessive debt, which could lead to financial crises. Another reason was to strengthen the existing risk-based capital requirements. Sometimes, risk measures could be fooled or manipulated, especially with complicated financial products. The leverage ratio acts as a backstop, catching banks that might try to hide their true leverage. It also helps supervisors keep a closer eye on how much debt banks are taking on overall. The introduction of the leverage ratio was a direct response to lessons learned from past financial crises. It became clear that relying only on risk-weighted assets wasn't enough to prevent dangerous levels of leverage. By adding this simple, non-risk-based measure, Basel aimed to make banks more resilient. It's all about making the financial system safer and reducing the chances of another big crisis caused by excessive borrowing.